Hey, how's it going, everyone? My name is Amos, and welcome back to the Dividend Compounder Show. So soon enough, a new presidential administration is coming into office. As such, a sector that has an incredible amount of economic moat, fundamentals, and finances is on the sell-off. No, I'm not talking about the health insurance industry, which is fantastic. I don't like them, but they're awesome. But instead, today we're going to be talking about the military companies. Reason being, the DOGE administration is spooking Wall Street when it comes to the short-term future for the military-industrial complex companies. So in this video, I'm going to articulate why the sell-off is happening, why I'm not too worried, and then at the end, I'm going to reveal my buying opportunities with a buy price target. Does that sound good? If so, let's get the show going. All right, so first up, the sell-off. So Wall Street is pricing in reductions for defense spending in the years to come, or at least for the next 4 years while the next administration is still in office. Elon Musk and Vivek Ramaswamy have been throwing around verbal threats of cutting federal spending, and that includes the military budget. What you see on your screen right now to help pay for all of that. They're trying to reduce the federal budget by $2 trillion no later than 2026. If you know anything about the military-industrial complex, it's contingent upon Congress cooperating with them and increasing their budget year over year. So this has every nipple on Wall Street lactating out of fear. They're concerned about the future. And then the other reason, which is a smaller factor, is that China, one of America's proposed enemies in the military world, but not economically, China is stepping up their game when it comes to fighter jet planes. And South Korea, which is an ally to the US, is catching up when it comes to naval vessels. But not only that, other countries are pumping out military technology as well. As such, Wall Street is losing confidence in the monopolistic grip the US companies have had for decades. But if you are realistic and you're going to be honest with yourself, who the hell is going to buy Chinese fighter jets in the Western world? Absolutely not. From Canada, the UK, Germany, France, no one's going to be buying it. Okay, well, maybe the North Koreans, and maybe the Russians, and maybe the Iranians. But I think our allies, for the most part, are going to continue buying American jets and American planes made from American companies. Although, on the other hand, remember, our allies that are usually dependent on us and buy our stuff are now building out their own arsenal and weapons. So that is a valid call out. Valid like Winston Churchill and the British holding down the European fort at the peak of World War II until the American giants were forced to fart freedom into the mouths of the enemies when the Japanese bombed the living heck out of Pearl Harbor. But really, Western Europe was falling one by one to the Nazis, and the only reason why the UK stood their ground is the English Channel, which meant the Nazis, if they really wanted to defeat the British, they had to commit to a land invasion because the Royal Air Force whooped the Nazis' booty holes in the Battle of Britain. It was an aerial dogfight that was awesome. Come to think of it, I also think that's a huge defensive asset the United States has. We are separated from the rest of the world by two huge bodies of water. So to execute an invasion or air raid is going to be dissolved immediately by our Navy or missiles or our Air Force. Anyways, circling back to the video, then again, when we think about it, the defense contractor's main customer and primary focus is our armed forces. And when I say our, I mean the American military. I would even argue there are stipulations and contractual agreements where certain weapons and tanks and ships and submarines cannot be sold to any other country because of the intellectual property, the technology, and we don't want it to get into the wrong hands. So when a defense company makes a super high-tech weapon, they are forecasting the future revenues to only be earned from the United States Department of Defense. Does that make sense? So the argument that the US is losing its grip on customers, it doesn't faze me too much. They're already pricing that in from the get-go. And you're absolutely correct. That was a mouthful. But for me, I see the sell-off in the military companies as a buying opportunity. This is a huge buy the dip type of chance, at least for me it is. But I get it. For some people, they might feel morally opposed to investing into these defense companies because it contributes to the potential elimination of human life. Likewise, there's some people out here that avoid tobacco stocks, and there's other people that refuse to invest into oil companies because they're a part of the whole green movement mentality. So you're free to invest how you see fit. But the thing is, the case that I'm going to present to you is that war will always be on the menu. Whether or not you want peace, it doesn't matter what your heart's intentions are, because war is a necessary evil. As long as there are demonic dictators and nations that are committing genocide and taking away human life, someone is going to have to stand up against them. Someone is going to have to fight that evil. And it sucks that the US takes the role as the global police to ensure world peace. But it's just how things are as of right now. That's the status quo. So love us or hate us, without the United States military, the world would face an increased risk of oppressive regimes rising to power. And nobody wants to see that, right? I mean, even in your own small circle, your wife is basically a dictator that is running the house, and you are losing all of your hair because of it. But I mean, it makes absolute sense as to why the United States spends more on their military budget than any other country. Our presence is required all around the globe. Or in other words, the great big war machine will continue on beyond your lifetime and your children's lifetime and your grandchildren's lifetime. War will always be on the menu. It sucks, but it's just how things are. And the thing is, as a startup, it's really difficult to come and challenge a defense contractor in what they do, especially with all of the R&D that is involved in producing a destroyer or a striker or a submarine. It's territory that no other company is going to challenge them on. For the smaller stuff like the drones and rifles, sure, a startup might come in and flip their world upside down and take some market share. But when we talk about the submarines, the cruisers, the tanks, the anti-air missiles and jet planes, absolutely not. So even if the defense companies trade sideways or even at a slight decline in the next year or two or even 4 years, I have a good feeling in my left nipple about their future in the long run. 5 years from now, 10 years from now, they're going to be compounding and growing like they have been for the past 20, 30, 40, 100 years. As a value investor that also follows the dividend growth philosophy, I like to buy good companies at a good price. These are solid, excellent companies that are trading at a massive discount right now that puts them into that undervalued category because Wall Street is fearing about their budget. What I'm trying to say is that there's many different ways to make a lot of money, right? You could do speculative cryptocurrencies, you could invest into growth companies like Nvidia or Broadcom, or you could buy the dip on a high quality company that is undervalued currently because you know it's going to rebound in due time. And I guess that's where my mindset is right now. I see opportunity and I just want to talk about it. So with that, my biggest convictions in the military companies, that watch list is going to include General Dynamics, Lockheed Martin, Huntington, Ingalls, Industries. And yes, we're going to talk about each one. So first up is Huntington Ingalls. They are America's largest military shipbuilding company, and I would associate them with the United States Navy and the Coast Guard. They make ships like carriers, cruisers, destroyers, submarines, and anything else that is related to the water. To see what I'm talking about, now let's go ahead and take a look at some numbers, and just a heads up, a fair warning, it's not going to be as thorough as I usually am, because if I did that for 3 companies, then this video would be like 2.5 hours long. So we're only going to look at some numbers on high level. Huntington Ingalls' current trading multiple is a 10.6. Their future trading multiple is a 13. Their 52-week range consisted of 184. All case and purposes, I think they're pretty much near their 52-week low, meaning in the past 365 days, we are seeing them at their cheapest valuation. They usually traded for around, what would you say, like 300-ish. Sometimes they go on a dip, but they always rebound. But as of right now, they are on a massive discount to their usual valuation, and the price target for them is 228, which is an upside of 22% from their current trading price. But let's take a look at some financials. The first one is going to be the income income statement, we want to know, is their top line growing, the revenue? And as you can see, year over year, it is consistently growing. Even despite this sell-off, their revenue still increased by 5.5% from the year prior. And if we scroll down to look at their net income, which is what investors refer to as the bottom line, it is just as beautiful. It went from $549 million back in 2019 to now $701 million. So both of those metrics are growing in the right direction. And when we take a look at their dividend profile, right now they have a 2.8% dividend yield. It's not the juiciest, but it's not small either. It's right there where it's kind of decent, which means for every share of Huntington Ingalls that you own, you get paid $5.40 in dividends per year, which I think is pretty fair. The dividend payout ratio tells us, is it sustainable? Is it healthy? Is there room for this company to keep growing and raising that dividend year over year? 30% screams absolutely yes. For a defense company, I think anything less than 80% as their dividend payout ratio means yes, a healthy dividend. For it to be at a 30%, they can grow this dividend by a lot more, but the leadership is playing it safe and conservative, and they're growing it at a very modest rate of 4.5% year over year, meaning their dividend payout every quarter that you receive is growing at a small but a steady and consistent rate. I mean, back in 2020, you got $1.03 every 3 months, and as you fast forward, now you get paid $1.35 in dividends. So their financials and their dividend profile, they both look pretty good. That is Huntington Ingalls, ticker symbol HII. Moving on to the next company, General Dynamics does it all. They do water, air, and land weapons, systems, equipment, and even software. But their bread and butter are the land monsters like the Strykers and the M1 Abram tanks. I would argue in the military world, depending on the context, most people associate General Dynamics with the United States Army and the Marine Corps because of those land monsters like what you see on your screen right now. Now, compared to Huntington Ingalls, their trading multiple is slightly higher, so they are trading at a premium at a 20. However, their future PE ratio is a 16.8. And when we assess their past 365-day range, it went from 247 all the way up to 316. I think right before the election, they were trading for about $314 a share. However, once the DOGE administration was announced and people were hearing about Elon Musk and Vivek Ramaswamy's words about cutting the federal budget, just look what happened to this company. It has just been demolished, absolutely brutally crushed. For a stock price to crash from $314 a share all the way down to $263, I mean, you can tell Wall Street is kind of scared to put their money into General Dynamics for the time being. The price target right now is $315 a share. So there is an upside of about 20% from their current trading price, which if you were to ask me to get a 20% return on my money in 1 year, I think that's pretty fair. And that's pretty good. No, this is not overnight get rich money like cryptocurrency, but it is still pretty solid. So let's go ahead and look at some numbers. The first one going to be the income statement to assess their revenue. In 2019, it went from $39 billion to now in the trailing 12 months, $46 billion. So it is growing in the right direction. Yes, they had a small decrease in fiscal year 2020, probably related to the pandemic supply chain issues. They went down by negative 3.6%. But what you want to see is a company that rebounds and grows in the right direction, and that is what General Dynamics has done. As we scroll down and look at their net income, which is the bottom line, is the company running a profitable operation? It went from $3.4 billion in 2019 all the way up to now $3.6 billion in the past 12 months. So it's not growing at an exponentially high rate like their revenue, but it is still decent and it is going in the right direction. So all case and purposes, their top line and bottom line, it checks out to me. It's a green flag. As we jump on over to their dividend profile, their dividend yield is slightly smaller than Huntington Ingalls because it's a 2.1%. Meaning, for every share of General Dynamics that you own, by the way, the ticker symbol is GD, you get paid out $5.68 a share. The payout ratio, super healthy, sustainable, 43%. I like to see that. They are growing their dividend at a rate of 7.5% year over year. I would even argue their dividend payment and profile kind of looks like Huntington Ingalls, even though Huntington Ingalls gives you a little bit more dividends when you break it down in a dividend yield perspective. So I would say their dividend profile looks good as well. And moving on to the third company, Lockheed Martin. They are best in class when it comes to fighter jet planes. They make the F-35, the F-22, and they even produce air defense missiles so that you can shoot down other planes. And if it's easier to remember, you can associate Lockheed Martin, ticker symbol LMT, with the United States Air Force. Let's look at their numbers and finances. And as we look at the profile for Lockheed Martin, their current trading multiple is a 17. Their future trading multiple is a 17 as well. And the 52-week range for them, it went from $413, I think back in February of last year, all the way up to $618 right before their most recent earnings. And I would argue that their price target right now is absolutely wrong, because after that earnings report, their share price has just been tanking. And then, of course, with the DOGE committee's verbal threats, they're just crashing even harder. So the price target for me, when it comes to Lockheed Martin, I'm looking at a range closer to $510 to maybe $515 a share. So when you think about it, currently trading for about $481. So the upside to $510 a share, not as juicy and not as high as Huntington Ingalls nor General Dynamics. And the reason why I disagree with the $615 price target is because Lockheed Martin disclosed that they're going to be experiencing some delivery delays regarding the F-35s, which are the new jet planes to replace the F-15 and F-16s. So when I factor in those delivery delays, I just can't agree with $615. I think that's way too overvalued for them right now. When they do make good on their promise and they get those F-35s pumped out of their production lines, yeah, this could be a possibility. But as of right now, I think Lockheed Martin is closer to $515 a share. As we jump over to their finances and we look at their revenue, yes, a beautiful picture. $59 billion in 2019. And for the past 12 months, $71 billion. This is awesome. This is beautiful. And as we scroll down and look at their net income, $6.2 billion in 2019. And for the past 12 months, $6.6 billion. So I would argue their bottom line is kind of similar to the growth story of General Dynamics. It's very slow, but it's stable and it is growing, just not at a rate that I would want, such as like Huntington Ingalls. So out of those three military companies, my biggest conviction is going to be Huntington Ingalls. It is the most undervalued of the three, has the best dividend by a small margin, has the biggest upside potential, and it has a pretty sweet backlog of aircraft carriers and submarines for the US Navy. I mean, to be honest with you, you really can't go wrong with any one of these three companies, but I am personally going to be picking up shares of Huntington if they reach this price target of about $185 to $188 a share, which they are right now. So I will be picking some shares up. For General Dynamics, I think a good price will be when they are trading for less than $250 a share, which at this point, at their current valuations, I don't think that's too far off. General Dynamics will probably bounce around that number soon enough. So under $250, I think is a buy for me. And last but not least, Lockheed Martin. Listen, I think they're super high quality, but I think they are fairly valued right now. Their upside from their current trading price, not as high as the other two companies. Meaning I'm not going to be interested in them unless Lockheed Martin starts trading for under $425 a share. So if it dips down below $425, I'll be monitoring them closely. And if Lockheed Martin hits a price of like $410 or even $415 a share, I think for me that might be a buy. Now here's the crazy thing. All else equal, I would buy Lockheed Martin over Huntington Ingalls. I think the future and the growth story of the F-35s and the United States Air Force has a compelling argument that I believe in a little bit more than the United States Navy. However, the Navy is only going to increase in size because I think in the United States, we're all starting to understand that China is building out this massive fleet. And if you know anything about the US, we don't like being second place in anything, except when it comes to soccer. I think we're stinky butthole when it comes to soccer, but that's neither here or there. All that to say, as of right now, with their current valuations and what is happening in reality, I think Huntington Ingalls is the better undervalued choice for right now over Lockheed Martin. So I would rank number 1 Huntington Ingalls, number 2 General Dynamics, and number 3 Lockheed Martin. However, if Lockheed Martin was trading for about like $390 or even like $400 a share, then I might even bump them up to second place instead of General Dynamics. And if Lockheed Martin, all else being equal, was trading for about like $320 or even $330 a share, then I would argue they would be first place and bump Huntington Ingalls down to second place. Does that make sense? So that's what I think. Let me know what you think, and if you want a deeper dive and a dedicated video into one of the defense companies, any of them, including Raytheon, Northrop Grumman, the ones we didn't even talk about. I just feel like it's a sector that I am pretty familiar with because I used to be an infantry officer in the Army before, so I understand the politics and the structure and the military budget from firsthand experience. I think as amateur investors, we're all experts in one field or another. You might be a truck driver. You probably understand the transportation and logistics industry better than your neighbor who's a doctor. Whereas your doctor neighbor probably understands medical devices, the pharmaceuticals, and the health business better than you. And then when it comes to your son who stays locked up in his room all day and plays video games, he probably understands the future of live streams, Twitch, and gaming platforms better than you do. I guess what I'm trying to say is that to hear an insider's perspective of someone who is a part of that specific industry or sector, I think it's pretty insightful. But anyways, if you found yourself nodding your head in agreement, then go ahead and watch my pharmaceutical industry video, because after I left the Army, I got my MBA and I ended up working in corporate for a pharmaceutical company, and I go over why I would never invest into pharmaceuticals. And just in case no one asks for a deeper analysis of the military-industrial complex and never end up making that video, I just want to throw this out there. The crazy thing about the military is that you'll have a full bird colonel working on the contracts on the DOD side. You can think of a full bird colonel as someone who's like a senior director or even a vice president at your company. And then after he retires and gets his pension after 20 years of service, he'll join one of these defense contracting companies as a vice president on the civilian side. So when you think about it, they have an incentive to make sure that the contracts are in favor of the defense companies so that they can get a good, welcome compensation package. It's an absolutely wild industry that has an unfair economic moat that I don't see dissolving anytime soon. On an unrelated note, I opened up a Twitter, and if you feel like it, go ahead and follow me because my own wife doesn't even follow me. So if you have an X account, I would appreciate if you follow me. And anyways, if you like this type of content on YouTube, feel free to subscribe as well. If not, it's okay. I still love you guys. Stay safe, and I'll talk to you really soon. Peace.